Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Frank Holmes. And Frank is the CEO and Chief Investment Officer of U.S. Global Funds. It specializes in natural resources and emerging market investing. We've had Frank on the show several times in the past, and it's really good to welcome him again. Thanks for joining me again, Frank.
It's great to be with you.
I want to ask you primarily, I think you find your new ETF, and you have two ETFs. One is has to do with the airline industry, and that's JETS. It trades in the New York Stock Exchange under the symbol JETS, $31.25, I think, when I looked at it earlier today. But the one that I'm mostly interested in, given my interest in the mining sector and the precious metals mining sector, is GOAU. GO, the symbol, Go Gold, essentially, and New York Stock Exchange traded $12.90 is where I saw it trading earlier in the day. Talk to us about this, Frank. This is a precious metals ETF, not the first one. You're not out there by yourself. JDXJ is there, JDX. Those are a couple of others. How does your fund differ from some of the others that are out there now?
Well, I think the big factor is the Quant approach, and what we did is that we have spent about 8,000 hours behind this particular product, and we found that even though our smart gold fund managers, Ralph Aldis, Top Gun, and myself, and we just weren't getting fund flows, Jay, even though we were outperforming the GDX and GDXJ, and in 2017, the GDX, or from 16 to 17, that June to June, GDXJ brought in $5 billion of new assets, and hardly anything went to the Tocquevilles or ourselves and other active gold fund managers. And so we became really keen at trying to fine-tune our own model and say, well, let's come up with a smart beta, a quant approach to picking these gold stocks. And so we had learned a lot from our JETS ETF, which was a smart beta, a quant approach to outperforming the New York Stock Exchange Global Airline Index. And so based on those rigorous hours of back testing, we were able to come up with a product that did it. And the gold one, when we created this product, we back tested it, and we found that it was outperforming the GDXJ 92% of the time in rolling 12-month periods going back a decade. Now, you can't really go to market that index because past performance, rightfully so, not a guarantee of future results, but there was something happening here. And so we were applying our explicit knowledge and our tacit knowledge of actually being good gold stock pickers, and then how would we create this system? And one of the things we found was royalty companies. So this unique product has 30% royalty companies, the three big amigos, Franco-Nevada, Wheaton Precious, and Royal Gold. And each year these stocks they outperform each other in different bases, but overall they have much higher revenue per employee. They have much more stable price to book value. We found that the quant funds that come in and buy these gold stocks don't care about NAVs being cheaper from one to the other. They're much more consumed with book value growth, and is the book value getting knocked down all the time. And so the royalty companies, when they do a financing, it's always accretive, so their book value is rising. And they don't seem to take these big hits and write-downs as the mining companies did in 2012 and 13. And so when we also looked at the GDXJ's constituents, the companies that go into the GDXJ, there was over 65 of them, and there was really something tragic, and that was there was 40% dilution a year. That is, these companies were issuing their shares from takeovers that didn't work out, and so what does that mean? Well, it means that either the price of gold goes up 40% a year, or the production rises 40% a year, or the reserves rise at 40% a year, and all three was just not happening. So you had a huge value destruction in that GDXJ on a per share basis. And so what we focused on was 28 stocks that were really caught up with who were the best at value per share. Not mergers A and B and they have more revenue and bigger projects. No. Who has given you the best each quarter? And we selectively did some back testing and mentioned earlier, we went through like 60 different factors, went back over a decade and say, just give me the 10 best stocks of the 88 global gold producers based on, let's say, revenue per share. And so let's look at cash flow per share growth and only pick the best 10 each quarter. And so what we found was that they outperform those factors on 10 names. But to have a mutual fund or to have an ETF, you have to have at least 20 names.
Sure.
So you need a concentrated portfolio. And because of that, we refined it to the key 5 factors: up cycles, down cycles, short cycles, long cycles, and this is how we were able to create a product that would outperform the GDXJ 92% of the time.
92% of the time. So the GDXJ, though, is comprised of a lot of juniors. I guess that's the J part of it, right? There's the GDX, right? The GDX, would that be closer to what you do, perhaps?
No, because we'll go down our model will go down to $200 million market caps.
Uh-huh. So that's the smallest, the $200 million.
Yes, and the same thing with the GDXJ. It goes down to that level. So what we did is we created tiers, but what happened, Jay, in that data mining and analysis is that there weren't that many companies that really had shown growth in their reserves per share, production per share, cash flow per share on a consistent basis. And so those that did those 3 factors in particular, they outperformed. And so we created this sort of basket, and we focused on the majority of the names are listed in Toronto or New York. And then when we went to specific Australian stocks, we had a smaller percentage that would be invested in those. So it would be capped at 2%, could be in any one name. And what that did was it lowered the currency volatility. And we learned that from JETS, Jay. When we created JETS, it's 80% U.S. stocks, but 70% of the names are foreign. And most of those 24 names are 1%ers. So you never get destroyed by one country's currency. And so for the past 3 years, the JETS has done exactly what it's said it would do. And so hopefully the Go Gold will do that. And I just think for the same expense ratio, basically, and cost, you have a far superior fund. And if you look at the index, it's doubled over the 10 years versus the GDXJ and GDX are both down between 40 and 50%.
Do you have any countries that are off limits for your fund? Or do you just stick to the metrics that you mentioned, the 60 factors?
That's a great question, Jay, because there are certain countries we just won't go into, and it's mostly because of liquidity, or some of those countries like Taiwan, South Korea. They won't allow you to do the trading mechanism is not clean, and so you can get. On paper, it looks like it's easy to do a trade, but actually executing on those trades is not. And Turkey was another one. And when we backed those names out, they really didn't have a significant improvement in the overall alpha. What was more important was having 30% in the royalty companies, and then the other tiered, so it's big cap, mid cap, and small cap, and foreign cap.
What the gold shares in general just haven't really performed as well in the recent past, anyway, relative to gold, the bullion. Why do you think gold shares are lagging behind, the underlying commodity?
I think a lot had to do with the GDXJ getting all the assets in 2016 to 17, that time period, where from June to June, and then they blew out in a matter of took a year to get $5 billion in, $3 billion went out within weeks. And that really damaged the psychology. I heard about this when I flew to Australia. I heard about it in Africa and England, that it had this sort of global ramifications of the markets. Now, the Van Eck people, they're great people, but the product itself went to show. And if you really want to play, boogeyman stuff, what happens to the S&P 500? When all of a sudden you have this huge concentration in only these names. Yeah. And all of a sudden, they own more than 10% of 20 names. Yeah. What happens then if all of a sudden they say, well, no, we have to get rid of some of these names? And what devastation will that cause? Because I think as a case study, Harvard style, the GDXJ is a classic of getting all the assets that would normally get spread amongst 10 active gold fund managers.
As I look at some of the names, the companies in your gold ETF, I'm wondering, some of these companies have real growth prospects as well? I mean, they're household names for the most part, and we know that the big companies are having a real tough time replacing their resources. Although, as I look over your list, it seems to me I don't see. Oh, I don't know. Newmont and some of the bigger Gold Corp is there, but not in a big amount. Kinross. Do a lot of your names have growth prospects in them built into their exploration development stories? Right.
That's another excellent observation. Yeah. One of the things in the quant world is it's sort of bifurcated, and there are all the laws of physics. So the laws of physics are either inertia, momentum, and growth, or they are value, mean reversion. Things will always revert back up to the mean. And so this portfolio is half of it's looking for growth momentum, stocks that have a stronger growth momentum, and the other half is looking at what are the cheapest stocks that have the biggest probability of a bounce. So each quarter it rebalances those names and looks for who's the cheapest on a set of 5 key metrics. And so I think Oceana Gold, which is growing in the U.S., it's more of that growthy name. I think that some of the other names just become because of currency volatility. I think Semifoil also has a very strong growth, and I think that SSR is just one of those great value propositions. And Guyana Gold, Gold Corp. Gold Corp doesn't really have the growth metrics, but it seemed to become undervalued on a relative basis. But it was out of there for a while. It just recently went back in. And Kinross has just recently gone back in. Who goes in and out is Harmony. And so I would say when you take a look at the 4 names, you can see Evolution, Santa Barbara. They're really growthy names. Some of the fastest growthy gold stock names were in Australia. It's just very evident. And they were also they were much more successful at delivering that production. But what you notice about those names, they're only 2%. And that's part of the whole idea, the concept of dealing with this currency volatility.
China is, the Chinese government has been encouraging people, as you know very well, to buy gold, to invest in gold, and the Chinese government has built up their gold reserves to a great extent. What do you think? And China, as I understand, is the largest gold producer. Are there any Chinese names?
Yes, there is. The one Chinese name, direct play, is Hengsheng Gold Corporation.
Oh yeah, I see it. Yes. Okay, but I mean, it's not the easiest place probably for people outside of China to invest in China.
Correct. So it's a Hong Kong company.
Yeah. What are your thoughts about what's going on now with the Shanghai Petroleum Exchange being denominated in yuan? Any thoughts about that and what significance it might have on world markets, on the currency markets?
Well, I think the whole part is that the big movement is to get outside of just people trading in U.S. dollars for trade, because everything has to go through New York. And what we saw from Saudi Arabia said, if China wants to buy the oil, well, we don't want to take renminbi unless it's backed by gold.
Yeah.
They'll take dollars. They don't have to be backed by gold, but they just don't trust the currency yet. So I think any country that really wants to have the power of the U.S. dollar from a liquidity point of view is going to have to give support, like the demands for gold backed. And that's what supposedly we're waiting here for the Chinese backed bond issue with gold.
Should be very bullish for gold, I would guess.
I think it's very bullish, and I'm very bullish on gold for several reasons. One is everyone likes to talk about the fear trade, but historically, Jay, this time of the year, after Chinese New Year, gold trades down until the summer. When you have the beginning of Ramadan, and we get the first sort of religious spiritual move in gold, and then we have Indian wedding seasons and New Year and Christmas and then Chinese New Year, that usually starts between May, June, bottoming, and runs to January, February. And this year we're having a rising gold market. So a lot of this has to do with a weak dollar, and I think that we're going to continue to have a policy. I think that President Trump, whatever he's been able to do is, even with rising interest rates, it's so surprising that the dollar's not rising relative to the euro and other countries' currencies. And what is that doing? Well, Boeing was up almost 90% last year, best performing Dow stock, because exports are exploding. Global PMI start going. So a weaker U.S. dollar is actually not just beneficial to our export market, it's beneficial to the world. It seems to be a catalyst for this sort of global growth, and it's good for the price of gold. So I think that that's one factor. I'm a big believer that we're in the peak zone for gold, and there's no new technological breakthrough. We had peak oil until the frackers came along and had this substantial, massive technological improvement in fracking, and that made a big game changer that the U.S. became the second biggest oil producer outside of Russia. And I just wrote a piece on that the success of Texas, where I compared Texas to Russia. You'll get a good chuckle over Investor Alert, what the differences are. But I think that we're going to see the dollar to maintain this weakness, even with rising interest rates on a relative basis. I think that we are also going to see that rising GDP per capita in China and India, which has been still maintaining itself. The correlation to the love trade is extremely high. 60% of all gold consumption is for love in China and India and the Middle East. And as long as that GDP per capita is rising, we're seeing in tourism. You see in New York City now, Chinese dominate tourists, visitors, especially from the New York Stock Exchange, the epicenter of financial capitalism. They all want to do a selfie. The tourists. And you see between San Antonio and Austin, Texas, the big outlet malls, discount outlet malls, they used to be in Spanish and English Visa ads everywhere. It's now Chinese. It's
Interesting.
Chinese for the rise of the middle class. And so this is the year of the dog, and there'll be lots of little golden doggies bought for anyone that has a zodiac year born in the year of the dog. As a
Interesting.
gift.
Yeah, interesting. I noticed in looking at your website, I think you had exactly that. You have some article perhaps on profiting from the rising Chinese middle class, right?
Correct. And it gets lost, in 1.4 billion people, but they have now more middle class than Americans. So when you have the middle class person making $100,000 a year, and you have 110 million people in China making $100,000 a year, the first thing they do is tourism. So America was always the dominant tourist country in the world, and we have 94 people making more than $100,000 middle class, as they call it. So I think that this is very bullish for gold demand.
It's also you have I think an article what's going on with blockchain and digital currencies. Frank, do you see that? How does that play into the gold markets, if at all?
Well, the big thing right now is the G20 cartel. The finance ministers, the China and the U.S. may be sword rattling and geopolitics and et cetera, but the G20 finance ministers function like they're OPEC. And they're all about global taxation and regulation. And so you're seeing that they're all, I believe, a concern for Bitcoin and the growth of cryptocurrencies. There's a big paper coming out in mid-July. And as soon as we started seeing the SEC, Congress, all of a sudden we saw the coins start to unravel in January, February, March. And the SEC has been going after ICOs. And I think that the Bitcoin is really not in competition with the gold investor. I think, if anything, in my research is that the gold investor, a lot of the early adopters, like Eric Sprott into the Bitcoin growth, they bought it, didn't sell their gold to buy it. They just diversified and put 1% of their assets into it. But I'm really big believer that the regulatory world, with good intentions, has basically chased away any speculative money for exploration or innovation in the stock market. And they basically shut that down, that speculation is only at casinos, lottery tickets, go play bingo, That's where you can go and speculate. But that's like prohibition. It never stopped people from drinking, and people want to speculate, and the millennials want to speculate. And it takes them 3 days to 5 days to open a brokerage account to go speculate in a junior mining stock, and it takes them 5 minutes to open an account at Coinbase, and all of a sudden they're speculating on a new ICO. And the math demonstrates that. Over $5 billion went to 1,000 new coins last year. So a lot of this speculative money for exploration, mining, and technology, etc., has now gone into these ICOs. What's important is that a lot of these ICOs became cheap capital for promoters, and there's been scams there. So the regulators are going after the scam artists. I think that's important to clean that up. But I do believe that there's something happening in those capital markets, and I think that a lot of the G20 countries are trying to slow down the growth and success of the crypto world because they're coming with their own coins. India wants their own coin. Russia has their own coin. Right. And so that's an important factor to consider. But blockchain is huge. You're seeing that blockchain will change the paradigm of stock trading. That there'll be, it basically would have really changed the paradigm of Bear Stearns and then Lehman Brothers going bankrupt. With all those derivatives, if they were on blockchain, they would have settled on time. And they would have settled every 10 minutes,
Okay, Frank, so I just realized, I just realized we're out of time. I hadn't been keeping my eye on the, on my engineer's notes to me, but I think we're going to have to let it go at that, unfortunately.
Happy investing.
Thank you so much, Frank, for being with us. Folks, it's usfunds.com. Go there and catch up on Frank's work. It's excellent. usfunds.com.
Go.
Well, thanks very much.